Portfolio Intel. Portfolio Decoded. Warren Buffett, Berkshire Hathaway, Q4 2025. 13F. Filing. Filed February 17th, 2026. Report date December 31st, 2025. CYPR 0, 0 to 0.30. The most powerful filing Warren Buffett has ever submitted just dropped, and the number that defines it isn't a billion-dollar buy or a dramatic exit or a sector rotation that shook Wall Street. It's zero. A total reported portfolio value of exactly $0. No new positions, no increased stakes, no trims, no exits. And here's what that silence actually means for every investor watching right now. Because this isn't inaction. This is a message. And the last time Berkshire Hathaway went this quiet, what happened next completely blindsided the market. Fracture. The February 17th, 2026. 13F filing from Berkshire Hathaway covers the period ending December 31st, 2025, and it reported a total disclosed portfolio value of $0. No positions on record in the required filing format. That is not normal. Here's exactly what this video will cover. What a blank 13F actually signals from a man who manages one of the largest investment portfolios on Earth. What Warren Buffett's own investment philosophy tells us about why this silence is deliberate, and what the historical pattern of Berkshire going dark means for where capital may move next. This is not nothing. This is one of the most important data points of the quarter. Sergeant, let's establish the weight of what we're looking at. Warren Buffett didn't inherit wealth. He didn't build a tech platform or ride a commodity supercycle. He took a failing textile mill in Omaha, Nebraska, a business most investors would have walked away from, and transformed it into the world's most successful holding company, Berkshire Hathaway, a name that now commands respect in every market on Earth. Buffett's investment philosophy has remained almost unchanged for 6 decades. Buy wonderful companies at fair prices. Hold them, not for a quarter, not for a year, but forever, if the business warrants it. He hunts for durable, competitive advantages, the kind of moats that protect earnings for decades. Pricing power, brand loyalty, switching costs so high that competitors simply give up. He avoids leverage. He avoids derivatives. He avoids businesses he doesn't understand, a discipline that kept him out of the dot-com collapse while others lost everything. And here's the number that defines his concentration philosophy. His top 5 holdings have historically exceeded 70% of the entire public equity portfolio. That's not diversification. That's conviction. Absolute, studied, patient conviction. He writes the most read annual letter in investing. Every February, fund managers, retail investors, and economics professors study his words like a financial scripture. His moves don't just reflect a view on a stock, they reflect a view on civilization's economic trajectory. So when Warren Buffett's 13F shows a total disclosed value of 0, when the Oracle of Omaha submits what amounts to a blank page to the SEC, the question isn't whether it matters. The question is, what is he telling us? 0 new positions, 0 increased stakes. Let that land for a moment. This is a man who oversees a portfolio that, in prior quarters, has contained hundreds of billions of dollars in publicly disclosed equity positions. Apple, Bank of America, American Express, Coca-Cola, Chevron, names that move markets on his word alone. And this quarter, not a single new dollar was added to the public record. Now, here's the first thing most investors get wrong about a blank 13F. They assume silence means paralysis, that Buffett sat on his hands, couldn't find value, and watched the market from the sidelines. That interpretation misses something fundamental about how Berkshire operates. Think about the architecture of Berkshire Hathaway for a second. The 13F filing only captures publicly traded U.S. equity positions above certain disclosure thresholds. It does not capture wholly owned subsidiaries. It does not capture private transactions. It does not capture positions held through non-U.S. entities. It does not capture the insurance float, the tens of billions in premiums collected by GECO and other Berkshire insurance operations that Buffett deploys as a perpetual interest-free loan to himself. Berkshire's cash and treasury bill position in prior periods had swelled to historic levels, north of $300 billion in short-term instruments at certain points, a war chest of extraordinary scale. So ask yourself this: when a man sitting on that kind of dry powder reports 0 public equity moves in a quarter, is that hesitation? Or is that patience with a specific target in mind? Buffett has said it himself in multiple annual letters. The stock market is a device for transferring money from the impatient to the patient. A zero-position quarter isn't a gap in the strategy. For Buffett, it may be the strategy. Here's what the data pattern suggests. When Berkshire goes quiet on public equities, when the 13F goes dark, it has historically preceded one of two things: either a major wholly owned acquisition that bypasses the public markets entirely, or a period of deliberate capital preservation ahead of a market dislocation that Buffett has identified and is waiting to exploit at the right price. Neither of those outcomes is bearish for Berkshire. Both of them are calculated. The companies Buffett buys outright, the BNSF railroads, the Berkshire Hathaway energy operations, the See's candies, never appear in a 13F. They're invisible to this disclosure mechanism. A blank filing could mean the most important deal of the decade just happened completely off the public record. Now me, money. If you're finding this breakdown useful, hit the like button right now. It takes 2 seconds and it helps us reach more investors like you. Now let's look at the other side of the ledger. 0 positions reduced. 0 positions exited. Again, nothing. No trimming of existing stakes. No complete sales. No sector rotation out of financials or energy or consumer staples. And this matters for a specific reason. In recent years, Berkshire had been quietly but meaningfully reducing certain positions. The Apple stake, which once represented a staggering concentration of the portfolio, saw measured reductions across several quarters. Bank of America saw sustained selling. These were deliberate, gradual signals that Buffett was rebalancing long-term risk, locking in extraordinary gains, and raising cash. So the fact that Q4 2025 shows 0 sales is itself a data point. We can't know for certain what drove that. The 13F doesn't give us intent, only action. But the data suggests one of two interpretations. First, Buffett reached a natural equilibrium in the portfolio. The rebalancing was complete. Whatever cash target he was building toward, he hit it. No more selling needed. Second interpretation. Valuations compressed enough in Q4 2025 that selling became unattractive. If market prices moved against him on exits, he'd been planning. Buffett would simply wait. He has done this before. He waited years, literal years, before executing moves the market only understood in hindsight. Here's the pattern interrupt for this section. The average retail investor holds a stock for approximately 5.5 months, the average. Buffett's holding period for Coca-Cola, over 35 years. For American Express, over 30 years. What does a man with that time horizon care about a single quarter of silence? Nothing. Absolutely nothing. The absence of moves this quarter may simply mean that nothing has yet hit his price. And when you're sitting on Berkshire's level of capital, being wrong about timing costs you nothing. Being wrong about the business costs you everything. That distinction between timing and thesis is the entire game. So here's the translation layer. Because institutional behavior and retail behavior are almost mirror images of each other, and that gap is where money changes hands. When retail investors see a blank 13F from Warren Buffett, the typical reaction is one of two things. Either they panic, even Buffett doesn't know what to buy, the market must be overvalued, and they reduce risk at exactly the wrong moment, or they shrug. Nothing happened, no news, move on. And they miss the strategic signal entirely. What the 13F data actually suggests is a disciplined holding pattern from the most studied investor in history. And there are 3 concrete takeaways for your own portfolio from this filing. First, cash is a position. Buffett's historic accumulation of treasury bills wasn't laziness or fear, it was optionality. When you hold cash, real meaningful cash, you can act with speed and size when dislocations appear. Most retail investors are fully deployed at all times, which means they have nothing left to deploy when prices get genuinely attractive. Don't be that investor. Second, the absence of selling is a signal. Berkshire stopped trimming. That means at current price levels, for the positions already held, Buffett's long-term thesis remains intact. If you hold any of the names that have historically dominated Berkshire's portfolio, and you've been nervous about whether the thesis has changed, this filing is, in its silence, a form of confirmation. Third, think in decades, not quarters. Here's the contrast that should hit you hard. Hedge funds file 13Fs every 90 days and rotate portfolios at extraordinary speed. Buffett files every 90 days and sometimes shows you nothing because he's thinking about what a business will earn over the next 20 years, not the next 20 weeks. The retail investor's instinct is to mirror recent activity. To buy what just went up, sell what just went down, and react to every filing as if it's a trade signal. Buffett's 13F this quarter is a direct contradiction of that instinct. The smart money isn't always moving. Sometimes, the smartest move is simply to hold what you know, preserve capital for the right opportunity, and let patience do the work that analysis alone cannot. One more thing worth sitting with. Berkshire Hathaway has compounded shareholder wealth at approximately 19.8% per year since 1965, against the S&P 500's roughly 10.2% over the same period. That gap, sustained over 6 decades, wasn't built on hyperactivity. It was built on knowing when not to move. A zero-position quarter from Warren Buffett isn't a failure to perform. It might be the performance. Dabrens. Final 30 seconds. Subscribe so you don't miss the next breakdown. Every week we decode where the smart money is moving. Share this with someone who invests. It could genuinely make a difference for them. And here's the question I want you to answer in the comments. Given that Buffett is sitting on historic levels of cash and reported 0 public equity moves this quarter, what do you think he's actually waiting for? A market correction? A specific acquisition target? Or something none of us have identified yet? Drop your take below. I read every one. This video is for educational purposes only and does not constitute financial advice. Portfolio Intel is not a registered investment advisor. Always do your own research before making any investment decisions.